The next reading I'll be covering is The Illusion of Internal Controls by Bill Atwood, Cecily A. Raiborn, and Janet B. Butler. Who is Bill Atwood? Well, he is a certified public accountant, a certified financial forensic accountant, and certified fraud examiner, as well as a software certified consultant. He also has vast experience working with land trusts and land conservation throughout Texas, including experience in tax, audits, estates, trusts, expert testifying, consulting, and environmental accounting. As for Cecily Rayborn and Janet Butler, I was not able to find as much information on them, but I was able to find that Cecily Rayburn and Janet Butler are both professors at Texas State University, as well as the fact that both of them have also attained their PhD, which may possibly have been after the writing of this article. But getting back to the article, the problem with internal controls is that they are often allowed to deteriorate over time or become ineffective due to organizational changes. This situation creates the perception of internal controls working properly when they are in fact ineffective. It creates problems for management accountants relying on said controls to protect assets, ensure the integrity of financial information, and prevent frauds. The five contributors to internal control illusions, which you can see in Figure 1 on the right, are organizational size changes, technology improvements, process changes, failure of physical safeguards, and employee failure to perform. So the first one, organizational size changes. Growth can create problems with previously working internal controls and create the need for new internal controls previously deemed unnecessary. An example of this is as an organization grows, tasks that were previously handled by the owner will be assigned to new people, in which case internal controls may be necessary. Furthermore, if mergers or acquisitions occur, differences in the company's IT and internal control system can create internal control illusions. Legacy systems may be duplicative, contradictory, or insufficient. An example of this in the writing was the merger between USA Waste and Waste Management Corp. in 1998, where neither company's IT system could handle the changes, and it took 2 years for efficiencies to occur. An even worse example was the merger of JP Morgan and Texas Commerce Bank shares in 1998, which took 17 years to fully merge computer operations. The next factor is technology improvements. Password controls can easily be bypassed. As you can see in this figure on the right, passwords can be given to colleagues or the list can be left in an accessible place. Furthermore, wireless systems may not be updated as security standards advance. For example, unsecure Wi-Fi networks. Or there could be breaches due to technological advances. For example, flash drives, cell phones, and micro SD cards. And lastly, there could be the possibility of only one person having working knowledge of the system. This creates a monopoly of knowledge, which would create a problem if that person is no longer available. The next factor is process changes. Over time, organizations may change the manner in which activities are performed, which could be due to a variety of reasons, such as possible inefficiencies, the implementation of new systems like a just-in-time system, or outsourcing. Every time the process changes, this will affect the efficiency of previous internal controls. Believing that old controls will be effective over new processes is an illusion. There was a quote in the article from Sir Francis Bacon from 400 years ago where he said, "He that will not apply new remedies must expect new evils." And in the case of internal controls, these evils may be fraud, waste, and abuse. The next factor is the failure of physical safeguard. Physical safeguards are worthless if not properly employed. For example, locks being left unlocked or keys in obvious places. Employees may be able to access documents that should only be accessible to upper management. An example of a failed physical safeguard is the collection of keys from employees no longer with the company, when duplicates could easily have been made at any point in time. Furthermore, companies may overlook the need to drop these employees from the computer database, allowing them access to continued organizational information. The next factor is the employee failure to perform. Employees may believe that the policy isn't time effective, thereby not conforming to the internal control, or they may trust others to do the right thing. Furthermore, they may decide to override the policy, be it for the right or the wrong reasons. Lastly, controls may also be overridden by management pressure. As you can see on this figure on the right, internal controls are created, but then the organization may go through any number of primary change factors, after which, if there is a non adjustment of the control, this creates the illusion of effectiveness. So, how to prevent illusions from becoming fraud opportunities? Well, Figure 4 presents a clear plan. Firstly, they require a cost perspective in designing and making changes to the internal control system. Second, management needs to exercise leadership with a detailed and workable plan. Without a plan, the organization will be unsure of the elements which need protecting with internal controls. Third, the organization must enforce compliance with the internal control policies and procedures. This requires involvement by all personnel and oversight to ensure existing controls are active. Fourth, awareness must exist to recognize how changes within the organization may affect internal controls already in place. Recognition of the implication of these changes is a crucial aspect of monitoring controls and ensuring that they are still viable. And lastly, the organization must practice risk assessment to ascertain the potential for failure if specific assets are vulnerable to fraud and abuse. In conclusion, internal control systems should be evaluated initially as well as continually as changes occur. Internal and external access, along with asset susceptibility issues, must be examined. People must be viewed as a paramount concern when designing internal controls. The internal control system must enforce compliance throughout the entity as well as externally among vendors, customers, and financial entities. Internal control deficiencies are often discernible as controls may be perceived to be operating as intended when they are in fact failing. For the system to function, internal controls must not be considered impenetrable, and a clear plan is required. Organizations must recognize that a fully functioning internal control system is the only true method to maintain asset protection and prevent asset loss. That concludes my two readings. Thank you for listening, and if you have any questions, leave them in the comments below. Thanks.